Hi guys, what's up? I hope everybody is doing good. Welcome to another episode of the stock market series. Of course, yeah, there was a break in between, but now we are back with episode number 4, wherein we are going to deal something very interesting, which is called the fundamental analysis. Now you keep hearing in stock markets a lot of calls being given that this particular stock has to be entered at this level and then you have to exit it at this level, hold your stop losses till this level, you can look for a target of this level. Now stop losses and targets have already been discussed in our previous videos, but then how do these analysts get there? What is the logic behind getting those numbers there? A quick understanding of how you by yourself can become a financial fundamental analyst of a stock is what we're going to see in this video. So without much of a delay, let's get started. So, what is this buzz around fundamental analysis? Why is it such a hype topic? Why are people really behind the fundamental analysis of this stock is very important? Check this before you buy it. Why is there a hype so much? Now, a stock trades at a particular value in the stock market, but does it really reflect the correct value? That is what is a big question here, because see, a stock may trade at whatever price people would wish to buy it. Does it reflect what is called as the intrinsic value of the stock? So before we proceed further, in this session you're going to be introduced to a lot of new terminology, lot of new formulae. Basically, there is a prerequisite that you have to have before doing the fundamental analysis, that is to have a basic understanding of what a P&L and balance sheet of an entity are. And also, if you are a little more well versed with financial knowledge, you should also have an understanding of what a cash flow statement is. So these financial statements, P&L, balance sheet, cash flow statement, they speak volumes about the operations of the entity, about what is the standing position and what exactly is the entity doing, because a future of an entity is dependent on, obviously based on its past performances, and these financial statements are a clear reflection of those past performances. Now, coming back to what exactly this intrinsic value of the stock is, people may be ready to pay more to buy a stock because they just want to go by the hype of the company or because of its brand value. But going by the books, does it really have so much value? Is also something that we have to clearly analyze. So, obviously, before you make a critical investment, when we are putting our money, we obviously would want to know where we are putting it. Is it the right place? So, we want to understand the health of the company, and not only the health of the company but also the future prospects. Till now the company was performing well. Sometimes it so happens that after we make an investment, then everything starts to work in the reverse direction. Now, why is that it was going up till a particular date, then why did the reversal start, did I take the wrong entry point? These sort of questions will always be in the minds of investors. That is exactly why you have to give yourself some time, what is called as a time horizon. A time horizon is very important from the point of view of an investor, because what is that you are willing to give in terms of time to the money that you put into the stock market? Are you going to wait for 3 months, 6 months, 9 months, or 12 months? So this less than 12-month investors are those people who are tracking quarter on quarter and who want to see the movement in the stock and then get a right entry point and get a right exit point. But when it comes to longer term investors who are looking at a time horizon which is more than 12 months, now again there is another category where we can say 12 months to 36 months, that is anything between 1 to 3 years, which is a good time for somebody to understand the company, get in, wait for the right times. And the advantage of giving yourself a higher time horizon is that sometimes even if you take a wrong entry point from a technical point of view, maybe you can then add on dips. That is, when you have entered a particular stock at a price and then it starts falling down, there is nothing to panic because you have given yourself a good amount of time. So that's where time horizon becomes very important. 3, 6, 9, 12 months, these kind of people deal quarter on quarter. 1 year to 3 year, people look at the strong fundamentals of the company and deal. If somebody is giving more than 3 years, which is where the great story starts. Of course, it is not a general rule that when you are remaining patient for many years, you end up making money, but in most cases, it turns out to be fruitful. So, what exactly is the fundamental analysis that we are supposed to do to pick up the right stock is what we're going to see further. And as I told you, three important factors that come in are the financial statements, the earnings, could be quarterly earnings or annual earnings, but earnings is one of the very important factors. And then, of course, the various financial ratios for which you need a little bit of technical understanding of the subject here. But for that, everything else is something that you can see and understand very easily. Now that I've mentioned about P&Ls and balance sheet, many people immediately have their own query saying that I am not somebody who's associated to this field at all. I've never seen a balance sheet or P&L in my lifetime. Will this apply to me also? Can I also read the financial statements? Of course you can, but you have to kind of spend some time in understanding the basics as to what are assets, liabilities, what goes into the income statement. So if you are spending some time on understanding how those financial statements are prepared, then reading it will not be an issue at all. What to read is what I'm going to actually focus now on throughout the video from here on. Now, can I be a fundamental analyst? If that is your doubt, the answer is a big yes, you can be a fundamental analyst. Of course, I keep telling in all my videos, if you really want to invest and then you want to seek a proper advice, then always look out for professionals who are in that field. They will give you the right advice. But also, having said that, if you want to venture out and do it on your own, nothing like that, you just have to concentrate on a few factors. What are the two important factors that one has to concentrate on while doing the fundamental analysis? Look, this entire concept of fundamental analysis is broken down into two parts. One is called qualitative analysis, while the other one is called quantitative analysis. Now, when I say qualitative analysis, there are a few factors that we have to consider, which are obviously intangible in nature because they're qualitative. And when we on the other side do quantitative analysis, it is to obviously more deal with the numbers and then using those numbers, constructing the ratios and then trying to understand the direction of the company. Let's first focus on qualitative analysis. What are those factors that we will be looking at in the qualitative analysis? Now, qualitative analysis, as the name goes by, generally deals with understanding who the management is, because if a company has to go in the right direction, it is the management who drive them in the right direction. But if you can ask me, like, say, will that have a serious impact? Like who the management people are, what are they doing? Of course, that's the most important thing. I give you one example here. Recently, there's a company by name Godrej Consumer Products, and there was an announcement saying the CEO is going to be changed. And then in the next trading session, the stock shot up roughly around 23%. Can you imagine? The stock shot up what? 23%. And just not just on the news of the CEO, of course, they were expecting a good set of numbers as well. So all put together, their stock shot up 23%. So if somebody new is coming into the management who people believe that will take the company to new heights, then of course, definitely people will start investing more into that sort of a company. And that is why I've seen the Tata Group, as long as Mr. Ratan Tata was actively involved, a lot of people always have banked on that particular group because they had trust in one such individual. So is the case with Mr. Narayan Murthy when he was in Infosys. So like that, a great management is what every company is struggling to find all the time, right? So if a great management is your asset, then definitely the company's performance will be very good. So the first and foremost thing that people look for when they do this qualitative analysis is who are the management, what is their past performance, what are they likely to do in the future. You keep hearing this term called as management commentary. So whenever a quarter ends or whenever the results of these companies are declared, these companies come out and they give a management guidance, a future guidance as to what they have planned for the company in the next 3 months, 6 months, or even in the 1 year horizon. People come out and speak. from the management, giving confidence to the public. So according to the management commentary also, the stock prices change very much in the stock market, because if the management is confident of hitting new heights, then obviously people tend to buy more. And then if the management is slightly skeptical about their next 1-2 years, which is what was happening throughout the pandemic, many companies were not confidently able to give a guidance saying that our next 6 months will be like this, or next 1 year will be like this, because uncertainties are at their peak in the pandemic. So we don't know what's going to happen. Suddenly there is a first wave, then the second wave, then people are adjusting, then vaccine shortages. Lots of external factors also dwell down into this story, right? So first and foremost thing, we always look at the management's background. Then how ethical was this company? Are there any corporate ethics cases on this company? So basically about a simple study of their ethics, because if the company has done something wrong in the past and it's known for something that it should not be known for, then that's not the company we are looking for. We don't want to put money into a company which is not good in its ethics. So management, then the ethics, then of course it's compliance with corporate governance norms. The lots of norms all these listed companies have to comply. So how compliant are they with the SEBI guidelines? How compliant are they with their corporate governance issues? See, if there are any corporate governance issues, it will come out in the news. So you need not know under which section they didn't report or under what they have not done. So if there is some non-compliance, it will all be there in the news so much. See, when good things are done, they won't tell about it. But when one non-compliance is there, they'll give so much hype to it and say this company has not done something at all. So these things will be very much out in the news. Little later in this video, I will also give you the right areas where you can pick up all this information from. And then how much salaries are being paid to the management. That's a very important factor we have to consider. Though it's not only a qualitative factor, it also involves an amount. But if high salaries are paid to management, and if of course there are Companies Act limitations, there are some specific percentages as the cap that you can give managerial remuneration. But having said that, if too much of remuneration is being paid, then what will we shareholders end up getting? So the salary part to the management is also something that you have to see. And finally, what are the ways the particular stock is being operated in the stock markets? A lot of news about operators being involved in pushing the prices up. Because sometimes what these promoters do is they pump in their money into the company, and then they get people who are stockbrokers. Now they are called as operators. What they do is they kind of take the stock prices up by pumping more money into the stock. How do they do that? And is it really something legal? Then why is SEBI not taking any call? We will discuss all this in another video. But yes, there is a scope that some people may run behind the stock, simply drive the price up, and we as retail investors will be very much focused. The stock price is going up so much, and then we put money into that. So you have to see this. And again, immediately it will come down also. In the same pace at which it went up, it will come down also. So then you can suspect an operator activity involved in it. So you have to be very, very careful before stepping into any of these stocks for the long term. And if you suspect that these kind of stocks are being played by operators, then better is to stay away. Even if you sometimes end up getting some quick money, but I don't think you should as a prudent investor try and do these things. But how will we really know that there is an operator involvement? That is exactly why you have to study the movement of the stock price in the last 3 months to 6 months at least. Were there any unreasonable going up or unreasonable coming down? Then you have to see what exactly was the reason, and then if you slightly dwell deeper into the story, you will get all this information. Begin with these 5 points in the qualitative analysis is more than enough to understand what sort of a company it is and what sort of a script it is. Moving on, let's go to the next very important part, which is the quantitative analysis. Now here, you don't have to struggle much nowadays to do the quantitative analysis, because there are lots of websites that do all this for us and help us with the ratios directly. All you need to see is whether those numbers are within the range that you actually want. But for your understanding, before I take you through a practical example, I will tell you what all you're supposed to see in a quantitative analysis, as you can see the list that's coming up down there. First up, we are always bothered about the profitability and the growth of its profits. So last 3 years, how did the profits grow? Last 8 quarters, how did the profits grow? You can do whatever analysis you want. See, once the numbers are with you, you can do all this analysis and you can apply your own formula depending on what you want to, analyze from here, from the earnings point of view, because there is a direct relation to the time horizon. Okay, if you want to stay longer in the stock, then there are a lot of things that you have to analyze. But if your time horizon itself is 3 months, then see, many people don't even do these fundamental analysis when they want to stay 3 months to 6 months. They just go by an analyst call. But when you want to stay longer, like say I've given myself 5 to 8 years in some cases, and I've seen things work with lot of patience. You have to see, in this 5 to 7 years, no, at least for 4 years, sometimes there is no movement in the stock at all, and from there on something remarkable happens, and then the stock price doubles up, triples up. And in my upcoming videos, I will show you how I have chosen 2 or 3 multi-baggers that gave me even like what 2500% returns. You won't believe that stuff, but I will in future make videos on that and show you what sometimes can work, not always. Sometimes as a early investor, I was eager, and then I put very small money into that particular company. Had I invested all my money that I had that time, probably it would have been a different scenario, but I put very small money into it, and then I still ended up getting a very fancy amount. And in terms of the return and CAGR, if you see, it's a huge number. I will show you that little later. So profitability, their margins, their earnings margins are very important. You will hear this word called as EBIT margins. So earnings before interest and taxes, which is a very important and critical number. Then it's earnings and growth perspectives. Then all the matters which are related very much to its expenses. Because if a company's expenses are going up. Now expenses, when we say, there are 2 types of expenses here which we have to bother about. The capex and the revenue expenditure. See, for everybody to run the company, they keep spending these revenue expenses. Or the salaries, rent, light, water, electricity, this keep going on, right? So they are all the revenue expenses. But what comes in as capex is the cost that they spend on their fixed assets. Now this is good, because when you're putting some capex, obviously you're putting into assets which are in turn going to generate revenue for you only. But is that capex well within the limit? Because sometimes when you make too much of capital expenditure and then you have working capital crisis, that won't again fare well for the company, because you put all your money into the assets and then you don't have proper money to run the company. This is like buying a very fancy car and not having money to fill petrol in it. So that won't be the right way to deal with. So how much money is being put as capital expenditure, how much money is being allocated for revenue expenditure, you have to have an understanding of that expenditure. Then dividend payouts are very important. This company, when it's making profits, what is it doing with the profit? Is it at least distributing a portion? Now many people buy stocks sometimes only to get these dividends. There are some companies which pay fancy amount of dividend. Okay, so even if their stock prices don't go up so much, their dividend payout itself gives them a better return than a fixed deposit or other bonds. So some people, they just invest money into that company and keep getting dividends. Most of the PSUs are like that. I mean, not all. Again, there are a lot of people who lost money by putting money into the PSUs. But some PSUs are there where they're predominantly, the main job is to do the business, keep paying good dividends. So some companies, they are always there which are good dividend payers. If you want to choose them as your investments, you can do that and take the dividend as a greater part. I told you how capital gains and how dividends are the 2 important pieces. Now if the stock value doesn't appreciate so much, but still you are getting your dividend, which is much more than the return that you will get from FD, you can still be very happy about it. So whether this company has been paying dividends, what's the track record of that? Not only that, very important part is the cash flows, where this company is getting its money from. You have to look at the cash flow statement for this, so that you know how much money are they making through their operations. And lot of companies, they put money into so many other areas, not just they're predominantly into only the business. They also put money. See, some businesses which deal in foreign exchange and all, they do a lot of hedging. So what is their forex income? Sometimes, they end up losing. So why are they putting money into wrong spots? So you have to understand all this. You can go through the cash flow statement, which is broadly broken down into three areas of operating activities, investing activities, and financing activities. So you can see them very clearly, where money is moving in, where money is moving out, what's the inflow, what's the outflow. So is the company paying attention to the cash that they have properly or not, is also something that you have to see. And then comes the very, very, very interesting and important point called debt. Whenever you're doing fundamental analysis, analyze how much debt that company has. Now, many times you hear analysts recommending you those stocks where the company is a debt free company. So the company is debt free, there is no compulsory interest obligation, because you don't have any debt, and then therefore there is no compulsory interest obligation. But if a company is burdened with debt, small percentage also, you have to obviously pay the interest for that, right? So definitely a portion of your earnings are going to go for the interest. So that is why many people, they prefer debt free companies, so that whatever earnings are made by the company are directly available for distribution. So there is no interest. And the same time, promoters, did they pledge any of their shares? Because if promoters are pledging their own shares, and they are running the company, then that's not a great sign. So I mean, of course, lot of companies do that. I'm not saying it's a bad sign, it's not a great indicator. Saying the promoters themselves have pledged, and if the promoters fail to release that pledge, so again, that will make, or that will turn out to be a bad investment for you, because when the promoters themselves are not able to push the company, we as an outside investor, we hardly have any role to play there. So you have to have attention to these two things very importantly. How much debt is there in the capital structure of the company? Is the company overburdened by debt, or it's a company completely debt free? And promoters holding, how much of the promoters holding is pledged? Is it really pledged? If promoters holding under pledge is zero, it's amazing. That means they are very much interested in holding their company. Because see, if you see the promoters holding, that speaks volume about the company. I will obviously show you in the example that we are going to deal with, wherein if promoters hold, let's say, 50% of the company, I can take the example of Reliance. So promoters hold roughly around 50% of the Reliance. So Reliance is roughly around 12 lakh crores of market cap, and 6 lakh crores belongs to that family, and that's why Mr. Ambani is the richest person in Asia, right? So if anything happens to the company, it has a direct impact on the promoter's wealth. And that sort of company where there's a direct relation like that, you obviously tend to see those people being more interested in running the company in that direction. Not only them, you pick up the top 10 richest people in India's list and see their listed companies, they'd have a solid promoter holding, because only those people who are holding 70%, 60%, or anything more than 50%, any movement in the stock market about their particular shares will also shake up their wealth. You can talk about Mr. Shiv Nadar, who is the promoter of HCL Technologies. You can talk about Piramal Enterprises. You can talk about Pidilite, which is the one that deals Fevicol. You can talk about Reliance. You can talk about Adani's. So there are a lot of listed companies where promoter stakes are so high that any activity in that company by the promoters will directly impact their personal wealth also. So is it a great choice to always invest in these sort of companies? Again, it's up to you to take that call. But of course, there is a little bit of risk involved in doing all of these activities. So irrespective of all that, we study what these fundamentals are and then take our call. So apart from understanding the debt and promoters holding, we also have to understand what is the growth in terms of the assets in the long run, in the short run. What is a growth in terms of a solid asset growth is also important for the entity. And then what investments did these companies make into other entities or subsidiaries? That is also an important part, because whatever this company is making, the money that they're making, where are they investing it? Not just in fixed assets and other places, but are they investing into any other companies? So if they are investing into any other companies, how much of that company do they really hold? So is it going to be something like that we hold more than 60% in that company or more than 51% in that company, that it becomes a subsidiary. So all these are again some important factors that one has to consider. So if we have invested like that, how many subsidiaries do we have? So if you go through the financial statements, a list of all subsidiaries also will be given in that. And then after understanding all these, one of the most important factors that you have to look for in the quantitative term is the financial ratios. So I'm going to talk a few of these ratios which are very critical in understanding this entire fundamental analysis. So now do you understand how interesting, intense and also difficult it is to do the fundamental analysis and give a call? So it's very easy to watch the TV and take the call, right? Rather than doing all this. Of course, if you want to do that, you can always seek help of a professional, as I mentioned it again. But if you really think that you should find some interest in studying and understanding all this, then it's also a great activity to do. So the ratio analysis is a never ending discussion. There are so many ratios that we can, actually focus on and keep doing this analysis. But I'm going to pick up 5 very important and instrumental ratios so that, they will help you understand what this company is all about. First and foremost, factors that we directly can ascertain from the P&L are something called as EPS, the earnings per share. How is it computed? From the P&L, you can obviously take the profit and then divide it by the number of shares that are outstanding in the balance sheet. So you would get earnings per share, EPS. Now, what's a very interesting factor using this EPS is you can also from the NSE and BSE pick up at what rate the share is trading there. Now, that is called the MPS, market price per share. See, if the share has the potential to earn 10 rupees and is trading at, let's say, 50 rupees, that means it's trading 5 times what its actual earnings are. So this is a very important ratio that we have to analyze, which is called as the price to earnings ratio or the PE multiple as we call it. So what goes by the PE ratio is market price divided by the earnings per share. The MPS divided by EPS is going to give you something called as the PE ratio or the PE multiple. Now, why this PE multiple is very important in fundamental analysis is if it's a high PE multiple, which means let's say the earnings are 10 and the PE multiple is 15, that means the stock is trading at 15 times. So people have to pay 10 into 15, that is 150 rupees to buy that stock. Now you tell me a fundamental value with earnings of 10 rupees, will you be interested to buy that particular stock at 150 rupees in the stock market? Is it really worth it? Is 15 the right number? Is 20 the right number? Now we can see some examples where the stock is trading at 150 times and 200 times also in the stock markets. Is it really possible? Of course it is possible. But is there a potential that suddenly the stock prices will start falling because that much valuation is not justified? Yeah, that is also possible. So to understand whether the stock is trading at the right PE, you have to also understand another term called the industry PE. Wherein every industry, you know that the entire stock market has various sectors like the metal sector, the bank sector, the pharma sector. So for each industry, there is an overall industry PE. Now you take the industry PE and compare it with the stock PE just to understand whether it is in line with it. Let's say, for example, in that industry, it is good to trade at 15 to 20 times the earnings. But your stock is trading at 200 times. Now that's a very alarming signal. And if I am the one who's making the investment there, I would be very, very cautious, because for something where the entire industry is ready to justify 20-25 times is now trading at 200 times. Now I don't want to definitely venture into such stocks. Now sometimes it so happens that where the entire industry is ready to do 20-25 times, your stock is dealing at 8 or 9 times. Now, which means this is a very underrated stock. There is a kind of influence that can happen on the investors in future, and they can look at these kind of low PE stocks, and many people may start putting more money into it, of course driving the price up. So that is also one of the reasons why low PE stocks have that interest. But there is no real justification to say that every low PE stock will match up to industry standards. The very reason sometimes can be that it's a non-performing entity, and that is why the PE is low. So it's always not that, every company which has a low PE multiple is an underrated company and it's going to be a multi-bagger very soon. No, there is no real rule like that. So you look at the PE multiple, see whether it is justified to buy that stock at 20 times, 30 times, 50 times. If you look at a company like Asian Paints, I give you this example because I like this example so much. Asian Paints, let's say the stock PE is around 80, 70 to 80, it almost keeps ranging between that. Stock PE is 80 times. So it is trading at, let's say, 2,700, 2,800 rupees as of now. It goes up and down there. And this stock has a potential to, double your money every 3 years. It's an amazing stock. Why? Because in the paint industry, there are very few players, and Asian Paints is obviously a market leader there. And though it's trading 70 or 80 times, there is still a justification. So this sort of an understanding can come from only one very important figure called the PE multiple. So whether it's a high PE stock or a low PE stock, we'll talk volumes about what it's going to do in future, and you can put all your interest here. Having said that, looking only at the PE ratios, you're not going anywhere, because there are two more interesting ratios that are coming up, which are called as return on capital employed and return on equity. So if an entity is a high PE entity having a high stock price, but it's not generating return on equity, then there is no point in investing in such company, because you're not getting any return on the equity. So though the stock price is driven up, there is all potential that it may fall. So there are two numbers that are very important that you have to look right after you finish doing the PE understanding is return on equity. Now return on equity is the net income divided by the shareholders' equity. Net income divided by shareholders' equity. That is how much of the money shareholders have invested. So net income of that entity divided by the shareholders' equity will give you something called as ROE, or return on equity. So higher the return on equity, fantastic that company is. But again, you can't draw lines always saying that the PE is high, ROE is also high, so blindly put money into that company. Then you might have to even look into the qualitative factors, as I told you. Sometimes it may so happen that the PE is high for one reason, that operators are playing. So you got to be very, very careful. Is it really a fundamentally strong stock? Sometimes, fundamentally strong stocks, because of the talk in the market, they start crashing. But if you look at their entire chart properly, they will also pull back. If in one quarter there is a fall, then immediately many people will panic and they'll start selling. And because the selling pressure goes up, stock prices crash. But patient investors wait and add on all these kind of dips. So that once you add on all these kind of dips, when it reaches a particular level that you want, you can exit at that point of time safely. Which is why I told about time horizon in the beginning of this video. Time horizon is very important, because throughout that time horizon you have to have patience. You should not get feelings like, did I invest in the wrong stock? Why is it going in this direction? What's happening to this company? Sometimes it so happens that the company has reported the best of its numbers. Okay, the PE multiples are well within limits. ROE is fantastic. Return on the capital that they've employed is also coming out well. Everything is going fine, but in the market, the stock price are not going up. There's some companies like that. Recently, I found one company like that by name Aarti Drugs. Aarti Drugs is a fantastically performing company, and their numbers are absolutely good. PE multiple is very much in line with the industry PE. Their numbers that they report are very well, but stock prices not driving up so much as they were driven in the past. Was there an operator activity in the past? No, I don't know. I'm not personally making any acquisitions there, but all I'm saying is, yeah, you can study the movement of these kind of companies to understand, because see, to make any call there, it's fundamentally important, because this was the same stock which declared bonus a few days back. So if you look at the balance sheet and P&L, it talks that it's a fantastic company. But when you come and see the performance here, It kind of, sometimes not matches up. Then there are companies like Dr. Reddy's and Divi's Laboratories whose valuations are so high compared to what their performance is. The stock trades at, 60, 70 times, which is again, very alarming. You're always having that feeling that when will this fall? Now, I've come across two companies by name Dixon Technologies and Amber Enterprises whose PE multiples are skyrocketing. They trade at 160 and 170 times. Do you really want to make investments in these kind of companies? Are those PE numbers justified? It's a very critical question, but if you look at their financials and their growth perspectives, they're amazing. And they have held that prices for quite some time in the market. It's not like, they shot up to that level and then suddenly started falling. No, they've held those prices for quite some time in the stock market. They were there in that range. So when people are keeping those companies in that range for quite some time, then it also gives you a confidence that, okay, the valuations, people are ready to take up these valuation. They are justified. So it's all not the numbers that alone talk. There is a market sentiment that also drives all these numbers. So PE ratios, return on equity, return on capital employed, what is the net profit after tax, which is the other number that I'm talking about here, is called PAT, the profit after tax, which is again a critical number. After paying all the taxes, what's the profit that's left over for the company? Is that a fancy number? To close out this topic on ratios, I'm going to give you another interesting ratio called the PB ratio, price to book ratio. Now, there is always a book value of a stock. Based on what the entire financials are, you end up deriving what is called as a book value of a stock. Now, in book value of a stock, you can always see what is the actual value of that stock as per the books. Then you can see what is the price in the market. Then price to book, you can compare. See, sometimes if the price to book is, twice, thrice, it's okay. Sometimes some stocks trade at 8 times, 10 times, which are way beyond, if book value of a stock is 100 rupees and it's trading at 1000 rupees in the market 10 times, very risky. I'm not saying that, you will always end up making losses in these kind of things. I'm saying it's a very risky investment. Will it hold on for a long time? So you have to consider these 5 factors that you see: PE ratios, return on capital employed, return on equity, profit after tax, and the price to book ratio to understand. Are there many more ratios that we can understand? Of course. So nobody can become a fundamental analyst by watching one video like this. But I think I've given you a greater insight on what actually is needed to do this analysis. You can now see a few more ratios that are, something that you can have an analysis of. And where do you do this analysis? Now let's get to that part before we wind up this video. There's an excellent website by name Screener, wherein you can go to a particular stock and identify all these details. So those of you who have understood things from this video, who want to do an analysis of any company that you know well, and you want to go and pick up some factors, you can concentrate on all these ratios that I generally look for. So now on screen you will be seeing what I can show you for, like what Reliance. Okay, we will see Reliance's Screener. You can go to Screener and then click on Reliance Industries and then see all these ratios. Generally what I see are all these ratios which I have discussed with you in this video, and then you can take a call as to what is the current level at which the stock is trading and what are the earnings of the company, how much is the PE, and what is the industry PE. You can compare those and then try and understand whether they are in line. Now this entire thing that I showed you and all these ratios, see, you can also see how much promoter holding is there, what is the market cap. So whenever I pick up a company, I look out for all these things that you see on screen immediately, and I have an understanding about it. And I'm not saying that will be the final understanding. I will dwell deeper into several more factors. And if you scroll down in the Screener website, you will also get peer comparisons. Now, whenever you're doing fundamental analysis, it's also important to do what is called as peer comparison, because only when you understand how others, the peers in the same industry, are dealing with, then you can confidently invest or not invest in any company. So you want to gain that confidence, then you also have to do peer comparison. Like I said, this was a total educating video on what fundamental analysis is. Maybe in future I will pick up exclusive one or two stocks and we will do the fundamental analysis of it. But I prefer you doing it on your own by understanding all this, because fundamental analysis is somebody's understanding of what the stock is based on. So if I do a fundamental analysis and say I feel this is a very high rated stock, the PE is very high, somebody else may come and say no, for me the valuations look okay. So every fundamental analyst will have their own view, which is why I didn't take one specific company and do this entire analysis. The fundamental for me is you have to learn all the factors and then do something on your own. So that's it from this video, guys. I hope everybody have understood so many things. Yeah, sometimes it might have sounded too technical, but with time and practice you will be able to understand much more of this. So just pick up one stock, go to screener, and try and do your own fundamental analysis, and do leave your experience of doing the fundamental analysis in the comment section, so that I will also get to know what exactly are you up to and what sort of videos you want to see. That also you can tell me in the comments, but don't tell me to give you stock suggestions or trade on behalf of you, which I'm not definitely going to do. And also wait for some exciting stuff that's coming up continuously in our next set of videos. So I will see you very soon, and stay in good health, take care, and do all of whatever you're supposed to do before you make an investment. See you in the next episode. Thank you. Bye bye.